So how could you be more creative on the digital platform and making the meaningful connections with the investors?
Well, look, so nothing has really changed in that regard. You want to be communicated. Look, nobody really wants to sit down with a sponsor and spend hours being pitched. Nobody wants to do that, and sponsors don't want to do it. It's a waste of everybody's time. Well, it's not a waste of time. Well, it is a waste of time. It's just an inefficient use of time, is what I should say. Inefficient. You got to book a time. You got to show up. You got to get through, niceties of chit chat and small talk, and then you get onto the business, and then whatever, and it just burns time. So for a sponsor, the best thing to do is to essentially put your investment thesis and lessons learned, if you like, onto your website. Make it easy for your prospects to research you. And that does not mean using ChatGPT.
Welcome to the Real Estate Wife Show. I'm your host, Vinki Loomba, and today I have a very, very, very good friend, Dr. Adam Gower, with me. Welcome, Dr. Gower.
Thank you for having me. It's a pleasure to be here.
So a little bit about Dr. Gower. He helps real estate sponsors build their investor list and raise more equity without having to spend all their time networking. He has more than 30 years and 1.5 billion of transactional experience in commercial real estate finance and investment. Today, he builds best of class digital marketing platforms for private clients so they can raise more capital online and provide online courses for those who want to do it themselves, all at gowercrowd.com. So this is the second time for Dr. Gower with us, and his previous episode is number 88. That was on content marketing in an efficient way. If you haven't checked that episode out, I highly recommend to check that episode out. It was one of our famous episodes, by the way. And today we're going to be talking about raising capital in the stock market, because we all know in today's stock market, raising capital demands very smart strategies and resilience. With economic shifts and tight competition, we have to have some innovative approaches and strong connections to raise good amount of capital. So it's all being agile, making compelling cases, and showing clear value to navigate the challenging landscape. So being that said, Dr. Gower, once again, welcome. Let's talk about challenge of raising capital in the tough market.
Sure. Well, okay. So from the very top, the ability to raise capital online from people with whom you have no pre-existing relationship. So that's a technical concept. Has only been legal for about 10 years. Right, prior to the Jobs Act of 2012. You had to have a pre-existing relationship. So in the last 10 years, and then the laws basically promulgated in around 2013, 2014. And the market started going down really early 21, really, mid 21. So for the last 10 years, excluding the last couple of years, this was the only time or the first time that investors, passive investors, had access to as much deal flow as they do, right? It was never, you had to know somebody personally in order to be able to invest in real estate. So there's this huge audience, if you like, or this huge population of investors, passive investors, who have invested for the first time in the last 10 years into a real estate syndication. That's one group. The other group are the sponsors who, for the first time ever, have been able to raise capital online. And so these two groups have never had, in large part, anyone that's come into real estate since 2012 has never before seen a downturn. And that applies to both sponsors and their investors, passive investors. So this is a new environment completely for all of these passive investors and also for sponsors who are new to the game. And so it is a very, very different market than when all you needed was a heartbeat and a down payment to be able to buy real estate and watch it grow, right? Watch the value grow. Suddenly we hit this brick wall. So now we have this very, very difficult, tough market that is a first time for investors and for sponsors. And cut me off whenever you want to say something, Vinki. I know you told me not to talk too long and jump in. So this is the first time. And so it comes as a shock to many people who never really expected or imagined that you could lose money in real estate. And the reality is that when the real estate cycle turns down, which it always does, people will lose money. And so what's happened is two things. From the sponsor perspective, there are lots of sponsors who are really struggling with cash flow challenges, primarily driven by interest rates first, but a slowing of rent growth trends, increased expenses with insurance, with capital expenditures, management, everything has gone up. So costs have gone up dramatically and revenues are coming down, or at least not going up at the same pace as costs. So there are a lot of sponsors who may not confess it yet publicly, but who are facing very significant financial shortfalls. Then there are investors, and those investors, some of them have already started to get a sense that things are not as they had hoped for. And the way that they're getting that sense is one of two ways. In fact, this whole thing behind me on the board here explains this whole thing. But the first thing that happens, in most likelihood, is your sponsor, whoever you invested with, goes quiet. They stop communicating in the same way as they used to. The next thing that happens typically is that distributions stop during this period of quiet. And then what happens is oftentimes when it's already too late, there is a capital call to save a project. Now, and so investors either know that there's problems or don't know yet, or they suspect there might be problems, but don't know how deep those problems are. And as a consequence, you have this very large population of investors, passive investors who have only come to real estate in the last few years, who are now worried about their investments. And because they're worried, that places a higher priority in their minds over investing in another deal. And that is what makes raising capital during a tough market, this tough market particularly, very, very difficult, because you are communicating with people who are losing money or are afraid that they're going to lose money.
Yes, I agree with you 100%. I mean, that's the sentiment. I see that too all around us. I mean, I'm in the same boat as well. But thinking about all those scenarios and all those experiences that people are currently having, that should not stop us investing, or that's not going to stop the economy either. So how do we get past that? And then think about it, okay, this is it, we might be at the verge of losing our investment. But at the same time, how should I shift my mindset into, okay, let me recover my money in another investment? Or what steps should I take for the due diligence perspective, what I didn't do that before?
All right, so that's a whole host of questions, but but really the high level answer to that is you've got to learn lessons from the mistakes that you made. And that's really the first. So I'll explain some of the lessons that you should be learning today as a passive investor, right? So it's that perspective we're talking about first. And then we can talk about the sponsor and how sponsors can communicate better. So the number one lesson to learn is that real estate always comes down in value eventually for a spell of time. And that you have to invest with sponsors and in deals that can demonstrate an ability to weather downturns. So how do you do that? Well, you've got to resist the temptation to chase what I call what I call the shiny object syndrome. And the shiny object is, ooh, look, a 30% IRR. That must be good. I am going to invest there. Don't chase those kinds of returns. The IRR is one of the easiest metrics to manipulate. And so you don't want to be chasing that. The key to success in investing in commercial real estate as a passive investor, or even as a sponsor, is to have a long-term patient perspective. And so if you are investing in deals that are flips, and by flips, I mean we're going to buy, renovate, increase rents, and sell within anything from 3 to 5 years, that is a flip. And the chances are, as many people have come to realize, you're going to get caught with your pants down, if you pardon the expression, right? This is Warren Buffett's idea that you find out who's swimming naked when the tide goes out. So it's very seductive as an investor to think, well, it's a 3 to 5 year time horizon, 30, whatever, 25, some big IRR. I'm going to invest in that. I'm going to make all this money. In your mind, you start thinking, well, I'm going to double my money. So I'm going to have this much money at the end of 3 years or at the end of 5 years. I'm going to earn all this income. And then you get all wrapped up in depreciation and deductions and all this kind of nonsense. And what you don't realize is that fundamentally the underwriting of that deal was flawed. And so you end up being attracted to deals that overpromise by looking at the promising returns that are unrealistic. Sponsors who have a very long-term perspective, and a lot of our clients are family offices, multi-generational family offices, and their policy is always, number one, protect the capital, period. We do not want to lose capital. And the way that you avoid doing that is by taking on less debt and having the patience to wait for the investment to grow gradually over an extended period of time. So they will underwrite a deal assuming that there will be a significant downturn in the market. And when they do that, what that means is they take on less debt. Their rent projections are going to be lower than anybody else that's racing to the finish. Their fees will be lower as well relative to other sponsors. And they will have underwritten a worst case scenario that says if the market drops 30% or whatever, right? You look at the local area, how bad has it always been? If it's dropped during the global financial crisis or now by 30 or 35%, they will underwrite their investment to that worst case scenario. What does that mean, Vinki? What that means is they pay less, and in all likelihood, their projected returns are going to be less than somebody who comes in thinking they can get in and out quickly in 3 to 5 years, who stack all their returns in fees up at the beginning of the deal. So they get a lot of their reward up at the beginning, and who pay more for a deal. Did I say that? They pay more because they've stretched their assumptions too far. And those are the people that are going to lose everything today. And the ones that win are the ones that pay less for a deal, underwrite more conservatively, take on less debt, project lower returns, but will survive.
But, and then you said a few things over here that I would like to emphasize on. First thing you said, underwriting is flawed, right? And a lot of times for the limited partners or the investors who are coming in as a LP into the deal, they might not even look at the underwriting, or they might not even understand the numbers 100%, because they usually go by whatever is projected on a pitch deck. Because like you use the word shiny object, I'm going to use it over here because this looks nice and shiny, very polished presentation that you follow and you feel like, okay, this is it. This looks good. I know this person. I like this person. Let me go ahead and take this shot. So how would you address that? The terminology that you use, underwriting flawed.
Yeah.
How do we mitigate that?
Right. So there's a couple of things that you need to look for. You got to
Mhm,
look for an alignment of interest between you and
mhm,
the sponsor. That's really key. If you lose money, will the sponsor lose money? I have
mhm,
looked at a lot of what I call influencer deals, right? People who do an exceptionally good job of marketing, who put deals out there. I've taken a deep dive into, I'm not talking about you, I'm talking about other people. In fact, you have a very different program. And I do want to ask you something, actually, but I want to switch it around in a bit. But I've taken a look very deep. And what I found, I'll give you one example. I found fairly consistently, a sponsor will tell you that they are co-investing a certain amount of money. So let's say it's a $10 million raise, and they tell you we're going to put in 500,000 or $1 million. In fact, there was one deal I looked at. I think it was, I forget the exact numbers, but this is basically it.
mhm,
But when you look at it, so they're going to put in $500,000 or $1 million into this deal. But if you look at it, the fees that they take out of it to start the deal, to get the deal going, acquisition fees, AUM fees, this fee, loan fee, whatever the fees are going in, and you've got to pull this apart. It's not so difficult to do. You realize that the fees they're taking out when the deal closes is equal to or greater than their contribution to the deal. If that is the case, there is no alignment of interest, or the alignment of interest is very, very weak. That means they're making money on day one. That what have they got to lose? There's nothing to lose. They're not putting real money into the deal. So that's a very important start. And it's not that difficult to do. You can jump into the offering documents, which are typically overwhelmingly complicated, extremely long, and full of legalese. But all you need to do is run a simple search in those documents for the word fees, and then have a look and actually calculate what those fees are. You want to look at that alignment of interest. How much they putting in? What are the fees? And then take a look and see, have we got some kind of, is this new money? Or are they taking my money and investing my money into this deal and then saying this is a co-invest? That's kind of one key example of what you should be looking for. And it's not difficult to find. The second thing that you can do that is not difficult to do is to ask a sponsor, what is the worst case scenario? How have you stress tested your underwriting, right? Let's take a look at that, right? Pull up the numbers. You've got these numbers. What is the worst case scenario? And what are the assumptions that you have built into that worst case scenario? And how do you expect to survive that worst case scenario? So there's all kinds of things you can look at. You could say, and here is where you've got to use your gut, right? And think, does this sponsor have the same perspective of where the market could go as I do? And if they don't, you might want to think about moving on. But for example, you could say worst case scenario. So if your sponsor says, okay, worst case scenario, rent growth trends will stop being 2% a month. And I've seen this, and it will come down to just 1% per month, right? That's the worst case scenario. Well, is that realistic? Is that really realistic? If you think yes, because the market has too much supply, too much demand, not enough supply, the economics, the companies moving, if you think that's realistic, that's good. But ask them to show you, I want to see what is the worst case scenario that you have underwritten, what the assumptions are. How, like, for example, interest rates. What happens if interest rates go up? Don't just assume they're going to come down. What happens if interest rates stay the same? What happens if they do go up? What happens if all of these things happen at the same time? If inflation hits capital expenditures and employment, etc., or insurance rates? How have you built your pro forma in a worst case scenario? And will you be able to survive that? Now, most sponsors will be able to say, well, yes, here are our assumptions that we've used, and this is why we think we can still make it. But you want to be digging down deep into those assumptions that they have written. Here's a good one for, so, well, actually, I'll give you an example of worst case scenario in ground up condo development, for example, or ground up single family home development. So we have a few clients that do that kind of work. So the worst case scenario there is that the market for resale collapses, totally collapses. And if it collapses, what could you rent these for? Even though that's not the business plan, what could you rent these for? And now underwrite to that. That is the bottom, right? That's really where the bottom is. And you want to be sure that your sponsor has taken on enough debt, made the right assumptions, and will be able to survive that worst case scenario. So those would be the two things I would look at. One, fees. Is there an alignment of interest versus how much they're putting in? And two, ask them, what is the worst case scenario? And what assumptions are you using? And how does that look in your pro forma?
That's good. So we have, talk about a lot of concerns that investors have and how they should mitigate that, or what they should look for in the pro forma or the pitch deck. What are the red flags they can find before investing in anything? So let's talk about, about the digital marketing or some of the creative strategies that you are using in today's market to raise capital. What is working, what is not working? Because being in the information technology age, I just feel like we kind of lost that human touch a little bit, because we are using more like the digital platforms, and it's working too. So how could you be more creative on the digital platform and making the meaningful connections with the investors?
Well, look, so nothing has really changed in that regard. You want to be communicating. Look, nobody really wants to sit down with a sponsor and spend hours being pitched. Nobody wants to do that, and sponsors don't want to do it either. It's a waste of everybody's time. Well, it's not a waste of time. Well, it is a waste of time. It's just an inefficient use of time, is what I should say. Inefficient. You got to book a time. You got to show up. You got to get through, niceties of chit chat and small talk, and then you get onto the business and then whatever, and it just burns time. So for a sponsor, the best thing to do is to essentially put your investment thesis and lessons learned, if you like, onto your website. Make it easy for your prospects to research you. And that does not mean using ChatGPT. If you start to use AI to concoct boilerplate, bubblegum content, you have no business being in this industry, frankly. And we won't take clients on that want to do that. I'll be really clear. You have to be authentic. You have to communicate authentically with your prospects. And that means actually, there are ways of making it easier to have to sit down and actually write. But you want to have written content that explains your investment thesis, that addresses investor concerns, that talks about your background, that discusses mistakes you've made or mistakes you've learned from other people making, and how you've adapted to those. So that's written content, because a lot of people like to read about a sponsor and their story, but also include video of yourself discussing these things, and do it authentically. Don't script it. The best way to do it is to record yourself, just like you and I are doing, right? Is to record yourself with somebody else in your office, or with a spouse, or whoever it is, who asks you legitimate questions. What lessons have you learned? Then talk to them naturally. Yeah, and this is what we do for our clients. I will interview our private clients. I will ask them, and I will want to know everything about their background and history and their story and their experience and the lessons that they've learned. And we do it in a casual, conversational way. Use that video, include that on your website, because that will then give prospective investors and investors a sense of who you actually are. Who is this person? Because at the end of the day, investors should be investing in the sponsor and not in the deal. It has often been said that a bad sponsor can blow up a good deal, or a mediocre sponsor can blow up a good deal, but a good sponsor can make a bad deal work, right? So you want to be focused on the sponsor and understanding who they are. And frankly, you want to be sure that they're making that easy for you. by being able to go to their website and access or preemptively find answers to all your questions about who they are and where they come from, what their investment thesis is already there, right? That's how you want to start to get to know somebody. If all you're doing is sitting in pitch meetings, then you are at the sharp end of a sales pitch. Do your homework and make sure the sponsor has made it easy for you to do your homework.
That's true. And plus, like you said it very well, that, you have to see what mistakes they have made, because if you didn't make any mistakes, you're not human, right? So you wanted to invest with a human being, not with a machine or somebody or just a salesperson.
But it's not just what mistakes have they made, Vinki. The key is what mistakes and how did you
mitigate that? Yeah, because that's very important. I agree with you, because the mitigation or the problem solving is very important than the mistake itself. And a lot of time people think it's a mistake, it's a big problem, but problem could be when you break it down to smaller chunks. It could be nothing. It's just like how they resolve any problem at their end. That's the most important thing. And I think that's what you need to learn, and that's what you need to look in a sponsor or in the general partnership team. Because the thing is, every investor is in the deal for experience. That's the way I look at it, right? Because they are so busy with their primary job, with their primary business, they do not have time to deal with the tenant, toilets, or termites. That's the reason they wanted to work with you. But they wanted to experience everything from 10 feet away. So if you keep them away from that experience, just showing them the good only and not showing the ugly, whatever we are experiencing, or how we're resolving all the issues or the problems, they miss out on that. And they likely not invest with you.
So that is exactly, so you've really hit the nail on the head, right? So a lot of sponsors are suffering significant failures at the moment on their deals, right? Deals that are worth less than the debt. This is total fail. And the problem is that it is a natural thing, actually, human nature, not just for sponsors, but in general, but it applies directly to sponsors who are in such a situation, to continue to put on a happy face, that everything's okay. Here, we're raising more money now for this deal. We've got a debt fund that we're raising money for. You've got to be very, very careful. Because sponsors will, again, human nature, not want to talk about how bad a deal has gone. I mean, we talk to sponsors all the time and investors. And it is, for me, it's frustrating to see how little true, honest communication there really is. Investors feel left out. They know something's wrong. They're worried about their investment, and all they're getting is happy emails. I see two things. One, either silence from sponsors, which is a dreadful thing to do to your investors. And the second thing I've also seen, which is almost as bad, is an overwhelming bombardment of highly jargonized communication to explain what's going on in a way that is clearly unintelligible to your investors. It creates this smoke screen. I've seen it. It creates this smoke screen of credibility, that we can talk this amazing language of the finance, of the capital markets and what's going on, etc. But if you read between the lines, all that's happening is we're stuck. We don't know how to get out. We've run out of money. And that's what you see. And that's what I've seen some sponsors do. So either they go quiet or they create this bombardment of kind of meaningless content. What you want to be looking for is just somebody who is authentic. Look, we hit our yeah, go ahead.
I was going to add one thing to that. Like you said, they go quiet or they just send the happy emails. I think it's not like the sponsor is, that particular person is bad. Another thing is, it's a human behavior, I would say very common behavior. They do it sometimes intentionally because they feel like, oh, I can do it. I can get over this thing. I can manage this on my own. And let me not share all my miseries or whatever I'm dealing with. and then create more chaos. Let me keep everything calm, but not by not communicating or just sending the good emails only, just showing the positivity only. I'll be able to handle it myself and I'll get through this quickly. But sometimes it backfires, not all the time, but sometimes it could backfire you. That's the thing. So I would not say that all the sponsors are bad or they do it intentionally, but it's just like some human nature plays a role in there as well.
Yes, and look, the key, so you're right. They keep it hidden, but the best thing is to communicate. I mean, that's the whole thing. Everything on the board behind me, everything in capital calls and rescue capital. You mentioned my book over here. Everything points towards communication. Right. So as long as you'll communicate, look, we've run out of capital. We're in negotiations with the bank. The bank seems amenable to an extension. This is what we're trying to do. We don't know if it's going to work. We hope that interest rates will come down. We figured that if we can survive until 25 or whatever you want to call it, we'll make our way through, but we need some capital just to cover these costs, etc. Then you can, that's good communication. But when you gloss over the troubles and don't want to confess, I was talking to one sponsor the other day who told me we've had 6 managers on this property in the last 3 years. What a disaster that is. What a disaster. Like, that is a failure on the sponsor side to take a deep personal interest in what exactly is going on at the site. If that was me, I would camp out, right? So we've got a problem over here. I'm going to personally take care of it. I want to know what's going on. And I'm going to hire somebody who understands what's going on, and so that I can manage them by understanding what's going on. If you're trying to do it remotely, chances are you're going to crash and burn. And he is not communicating with his investors about this. Was a confidential call that they had with us. This is what's happened. We're just so far behind on this particular asset. It's keeping me up at night, he told me. And but he is, everything you see that goes out is all butterflies and rainbows. That's not right. You've got to communicate as you would communicate to somebody who's a debt fund who's there to help you, really wants to know what's going wrong. Talk to your investors that way as well.
I agree on that. Since you mentioned your book, let's talk about that too a little bit. We're running out of time, but I wanted to ask you, you wrote a new book on capital calls and rescue capital training. What is that all about?
Yeah. So when the market at the beginning of, well, hang on, wait a minute. When did I write this thing? So the market's turned really bad, as you know. So I decided, and it's been frustrating. I mean, I've been teaching about downturns ever since I started 10 years ago doing this in this business. But it's funny, the only time anyone really pays attention is when it actually goes bad. It's like, all right, now we need to figure this out. It's like when it's too late already. So I decided to put together some training with some seasoned sponsors, people who had been through, and attorneys who have been through multiple cycles, who have learned from their own mistakes, but also learned from other people's mistakes, and who could provide guidance to both sponsors and to investors on how to navigate the downturn, this current downturn, and what to look for in capital calls. So the book it's a $7 book, Vinki. It's on my website there at gowercrowd.com. And I'm not very good at selling, but if you don't like the book, I'll send you $7 back. But it comes with all the videos of the conversations that I had with these experts. It's extremely high value coverage of what happens during a downturn. It's not necessarily easy listening, but it will give you deep insight into what to look for during a downturn and how to react to a capital call.
Okay, so let me ask you one question before we end the conversation. So in your crystal ball, what do you see next for this year, next year?
Right. So there's going to be a flushing out of dozens and dozens of sponsors. They will fail. They will lose their investor capital, and they will leave the industry.
Yeah, but what do you see from the investor perspective, from the capital raising perspective? What is going to look like? How the digital portals or platforms play a role?
Well, so you got to have your own digital platform. That's kind of the key, right? So you got to have your own. You don't want to be just looking to third-party marketplaces. They only take a tiny proportion anyway. So you've got to really have your own digital marketing platform. And that's not changed. In order to be successful raising capital in the next 12 months, there are probably three things that you need to have. One, absolutely authentic, detailed, and continuous communication. That's number one. And that is warts and all. Secondly, keep your eyes out for non-performing asset, for distressed real estate. So if you find distress, that is something that investors are interested in. And the third thing really is to communicate that your number one objective and priority is to protect investor capital, period. That, and you've got to be able to demonstrate that that is your number one priority, even if all you're offering is a 2x on your investment in 10 years and another 1x through distributions in that time, right? So now you're looking at low teen IRRs during the life cycle of your project. Have the conviction to be able to run realistic scenarios and communicate how you're doing that, why your returns aren't off the charts like everybody else's, because you are focused on protecting investor capital. So those are the three things I would say have front and center, but you've got to have a digital marketing platform. You've got to have your own custom crowdfunding platform in order to be able to communicate effectively.
Nice. Thank you. One more golden nugget for my audience.
Another golden nugget. Another golden. Well, goodness me. So can I pitch?
Yes, you can pitch.
All right. So the golden nugget is, so we've got this book here, Capital Calls and Rescue Capital, but there's another book I wrote called Syndicate. Now it's on my website, gowercrowd.com. Scan down to the bottom of the homepage. And that actually covers everything that you need on your website to be an effective capital raiser based on, I don't know how much we've raised, Vinki. I mean, hundreds and hundreds of millions of dollars. Our clients manage over 35 billion of AUM. So based on the experience that we have building websites and helping them to raise capital, my book Syndicate explains in detail exactly how your website should be structured, what you should have on it, exactly. And it comes with some training from me as well. And that's probably the most valuable tool in your arsenal. Again, it's only a $7 book. Yeah, that would be the most useful thing that you could do, is to build your crowdfunding platform yourself using that as a guide.
Perfect. Thank you so much. This brings us to our rapid fire round. I'm going to ask you 5 questions that I tailored for you only. So you're going to try to answer in 1 word or 1 sentence only. Are you ready?
I'll do my best. You can tell I'm not very good at keeping things short, but I'll do my best.
1 word or 1 sentence only.
Okay.
We're already over time. How do you stay resilient in the face of financial market volatility?
Patience.
Good one. What's your go-to strategy for maintaining investor confidence during economic downturns?
Communication.
Love that. In a single term, how would you describe the essence of successful capital raising?
Authenticity. Be authentic to who you are.
I like that as well. What drives you to innovate in the challenging landscape of real estate investment?
Be constantly learning things that maybe you don't even want to learn about.
That's a really good one too. Reflecting on your journey, what advice would you give to emerging real estate sponsors navigating their first capital raise in a tough market like this?
Yes. Be willing to take well-calculated risks.
That's a good one.
Don't shy away from making your first move, but be really careful that it's a winner.
That's a good one. Thanks, Dr. Gower. How can people reach out to you?
Thank you so much. So gowercrowd.com, that's my website. We have a weekly newsletter that you can subscribe to. It's free. There's a big button there that says subscribe, and you can always unsubscribe. So that's really the best way to make contact.
Thank you, Dr. Gower. I really enjoyed our conversation today.
Thank you for having me.